What if I told you the biggest stock winners in Singapore this week weren't even Singaporean companies? While most investors were sleeping on traditional SGX stocks, smart money was quietly flowing into something completely different, and the results were explosive. Hey there, I'm Iggy from the Investing Iguana, ranked 8th in Tiger Broker's 2024 Influential Tigers, and we just crossed the incredible milestone of 1 million reads with 58,000 likes across our content. With over 600,000 watch hours from more than 1,000 videos, I've been tracking these market shifts for years, and what happened this week is a game changer for Singapore investors. Adapted from my latest in-depth Substack deep dive, today we're breaking down why China tech stocks and Thai blue chips absolutely crush traditional Singapore picks and what this means for your portfolio strategy going forward. Here's our roadmap. We'll examine the 5 biggest winners that caught everyone off guard, dissect the 5 worst performers that had investors scratching their heads, and then I'll give you my personal take on each stock with clear buy, hold, or sell recommendations. Plus, we'll explore how Singapore's SDR program is quietly revolutionizing access to international markets right from your SGX account. Let's start with the elephant in the room. Singapore Depository Receipts, or SDRs, just proved they're not some obscure financial instrument. They're becoming the secret weapon for local investors who want international exposure without the hassle of foreign trading accounts. Think about it this way. Imagine you're a coffee lover who's been limited to the same 3 local cafes. Suddenly, a new mall opens up with international coffee chains. Same convenient location, same local currency, but access to flavors you've never tried before. That's exactly what SDRs are doing for Singapore investors. The numbers don't lie. This week's top performer, SMIC, a Chinese semiconductor company, surged an incredible 24.79%. That's not a typo, nearly 20% in 1 week. CATL, the world's largest EV battery manufacturer, jumped 17.97%. Alibaba climbed 10.85%. These aren't small cap speculative plays. These are industry giants accessible right through SGX. But here's what really caught my attention. While these international powerhouses were soaring, traditional Singapore stocks like CMS dropped 5.65% and HPH Trust fell 3.77%. The market was sending a clear message about where the growth opportunities really are. Now let me break down each winner and what drove these explosive moves. SMIC's 24.79% gain wasn't just market euphoria. 3 massive catalysts converged at once. First, reports about Huawei's advanced chip technology prove China's semiconductor capabilities are real. Second, NVIDIA's CEO admitted China is only nanoseconds behind the US in chip manufacturing. Third, new AI applications created fresh demand for computing chips. Goldman Sachs completely reversed their stance, upgrading SMIC with a new target price. When Goldman changes their mind this dramatically, smart money pays attention. CATL's 17.97% surge reflects something even bigger. The global EV revolution, with a 38% market share that dwarfs most competitors. Revenue hit 1.13 trillion yuan with a dividend yield over 7%. For Singapore investors, this represents exposure to cutting-edge technology that simply doesn't exist on SGX. Alibaba's 10.85% gain was driven by real AI monetization, not just hype. Their mapping app processed 2.6 billion AI requests in a single day from 360 million users. JP Morgan raised their target by 45% to $245, citing cloud revenue growth of 26% annually. For all the detailed performance tables showing exact percentages, sector breakdowns, and key drivers, grab the full post on Substack, link in the description. Now, what about the losers? PopMart dropped 4.09% as the Labubu toy craze finally met reality. CMS fell 5.65% despite solid fundamentals, showing how sentiment can override good numbers. HPH Trust declined 3.77% on global trade concerns. Here's my personal take on each stock, starting with the winners. SMIC represents China's tech ambitions backed by massive government support, but it's also vulnerable to US export controls. I see this as a tactical buy for aggressive portfolios, but keep watching Washington's moves. My rating, speculative buy with tight risk management. CATL is different. It's the Tesla of batteries with genuine technological leadership. Short-term volatility is expected, but long-term, this is a buy and hold opportunity for anyone wanting EV exposure. My rating: strong buy for growth investors. Alibaba offers AI cloud leadership at reasonable valuations after years of regulatory overhang. The recent pop validates my thesis that quality eventually wins. My rating: buy for long-term investors willing to handle some volatility. For the Thai stocks, Airports of Thailand benefits from Asia's tourism megatrend, but the easy money might be made. I'd rate it hold, adding on meaningful pullbacks. Delta Electronics is a steady compounder in automation, less exciting but reliable growth. Hold for most, buy for tech diversification seekers. On the losing side, PopMart teaches us about hype-driven investing. When executives sell at peak prices, that's your cue to exit. My rating: sell until fundamentals drive the business, not plushy fads. CMS has solid numbers but faces regulatory headwinds in China's pharmaceutical sector. The valuation is attractive, but I want clear regulatory visibility first. My rating: watch list until the political clouds clear. HPH Trust represents the classic yield trap. High dividends masking declining fundamentals. I'd rotate those funds toward more robust infrastructure plays. My rating: sell for most investors. Here's the bigger picture that every Singapore investor needs to understand. The traditional defensive plays like REITs and utilities are losing relative attractiveness in a growth-focused market. SDRs provide access to higher growth international markets that SGX simply cannot match domestically. Smart portfolio allocation might include 15 to 25% in carefully selected SDRs, particularly in sectors where Singapore lacks domestic champions like semiconductors and EV technology. This provides diversification while maintaining SGD convenience and Singapore regulatory oversight. But remember, with great opportunity comes great responsibility. These high-growth plays can reverse quickly, as PopMart's rapid decline demonstrates. Risk management and position sizing become absolutely critical. The investment landscape is shifting, and Singapore investors who ignore this evolution risk missing the next phase of market growth. The winners this week weren't lucky picks. They were companies positioned at the intersection of technological innovation and market access. So here's my challenge for you. Are you ready to expand beyond traditional Singapore stocks while maintaining proper risk management? Are you willing to embrace the SDR revolution that's quietly transforming our investment options? The evidence is clear. International growth themes are attracting premium valuations while traditional defensive sectors face headwinds. The question isn't whether this trend will continue, but whether you'll position yourself to benefit from it. If you found this breakdown valuable, smash that like button and subscribe for more market insights that matter to Singapore investors. And hey, if you're serious about staying ahead of these market shifts, consider joining our premium Substack community where you get exclusive deep dives, detailed analysis tables, and actionable investment frameworks delivered straight to your inbox. Next week, I'll be diving deep into the Federal Reserve's next moves and how they'll impact Singapore REITs versus international growth stocks. You won't want to miss that analysis, so hit that notification bell and I'll see you in the next video. Until then, keep investing smart, Singapore.